So put all that stuff together and you get a slowing consumer spending, slowing housing, and an economic contraction in the year ahead, and then probably an equities bear market because those things usually go together. But that's kind of a normal prediction. Things like that happen every 10 years. So it's no big deal really that it happens soon. The much more interesting time frame is the coming decade, because in that decade, it looks like the fiat currency, fractional reserve banking, global military empire experiment that we started in the 1970s is finally going to fail catastrophically.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. History is full of examples where nations resorted to taking on ever-increasing amounts of debt to maintain a positive economic growth rate. But it never works out well for those who do. Most often, they end up sacrificing the purchasing power of their currencies in the process. Many analysts are now raising such concerns about the fast-growing national, corporate, and consumer debt pile in the US and other G7 nations. Are we repeating the mistakes of history, or is it truly different this time? To discuss, we're fortunate to welcome monetary and macro analyst John Rubino back to the platform, author and co-author of numerous books, including The Money Bubble with James Turk. John, thanks so much for joining us today.
Hey, Adam, great to talk to you again.
Hey, John, it's always a pleasure. You and I, you're one of the guys that I talk with at least every couple of weeks or so. We have wonderful discussions on the phone just between the two of us. You also give great, much more sort of professional level discussions when you come here on the channel. I'm hoping today maybe can be a little bit of a blend of both of them, where we go through your usual analysis with your traditional rigor, but maybe we also opine a little bit the way that we just do when we're talking informally on the phone. If we can, let's kick things off with a question that I like to ask everybody at the start of these interviews. What's your current assessment of the global economy and financial markets?
Well, there are two different time frames that are both really interesting. And the year ahead time frame is basically downturn, equities bear market, that kind of thing. And the reason for that is actually there are lots of different reasons, lots of different trends that are kind of under the surface. They're not headline trends, but they all point in the same direction. And one interesting one is something called excess savings, which is money that you accumulate in bank accounts or wherever above what previous trends would have predicted. And that happened with US consumers during the pandemic. We built up like $2 trillion of excess savings. And we spent that money, and that's why the economy continued to grow rather than tipping into a recession and staying there because of the pandemic. Well, all that money's been spent now, and it's gone, and a growing number of people are having to put day-to-day life on plastic, which means you got millions of Americans who are carrying debts that charge them 20 to 25%, which is a recipe for either personal bankruptcy or at least dramatically lower consumer spending. So that's the consumer side of the story. Meanwhile, commercial real estate is having a mini crisis right now, where office buildings are plunging in value, having to be sold at big losses, and those losses are starting to hit local and regional bank balance sheets, which is probably going to cause some kind of banking crisis in the year ahead. And finally, housing is just frozen. House prices have gone up so far, so fast, and mortgage rates are now way up, so that the average person can't buy the average house anymore. So hardly anybody's buying anything. Houses that are being sold right now are mostly going to private equity vultures who buy up whole neighborhoods with super cheap money and then convert the houses to rentals and then try to squeeze as much rent as possible out of people. So put all that stuff together and you get a slowing consumer spending, slowing housing, and an economic contraction in the year ahead, and then probably an equities bear market because those things usually go together. But that's kind of a normal prediction. Things like that happen every 10 years. So it's no big deal really that it happens soon. The much more interesting time frame is the coming decade, because in that decade, it looks like the fiat currency, fractional reserve banking, global military empire experiment that we started in the 1970s is finally going to fail catastrophically. And I base that on really just a couple of stats, which are the debt levels of major countries, which have started to go parabolic, and the interest on those debt loads, which also has gone parabolic now, because now we're in a globally, we're in a death spiral financially, where rising debts leads to higher interest expense, which of course has to be borrowed, which raises debts even further, which raises interest costs even further, and so on, until you get a lot of bankrupt governments out there. And at that point, the currencies become the problem. They start to fail, and then you have to have a currency reset. And so that's the kind of a decade that we're looking at, which is just a fascinating process from the standpoint of economic theory, but probably terrifying for regular people who aren't paying obsessive attention to this to have to go through.
All right. Okay. Well, you gave us a lot to think about there, John. I threw a couple of the charts up that you'd sent over while you were talking. Maybe we'll bring them back up again in a moment. Um, so near term, kind of garden variety economic slowdown. We didn't use the word recession, but do you think recession is likely in the nearer term, meaning next 1 to 2 years?
Yeah. When you have a commercial real estate and banking crisis and consumer spending starts to go down, that usually means the economy shrinks. And meanwhile, we've got equities that are just wildly overvalued by any reasonable measure. So you could have a massive equities bear market once the economy starts to slow down. So you put those things together, and a recession is to be expected. But again, that's not, I mean, it's scary when it happens. And because we're so indebted, any garden variety recession could easily metastasize into something much worse. But it's not unfamiliar. Um,
No, it's
I've
not.
I've lived through a ton of recessions, and you've lived through quite a few.
Yeah, and I mentioned this in an increasing amount lately, which is, we should look at a recession the way that we look at winter, right? It's just part of the natural cycle of seasons, and it has a role to play, right? Yeah, winter's cold, and in general, we'd probably prefer it to be spring or summer. But it gives the land a time to heal, right? And it renews everything for the next cycle. And in business, it's the bust cycle where you're supposed to clear out all the malinvestment that shouldn't have been taken on when things were going great, right? So it's really just sort of a natural, healthy, cleansing part of the economy. But somewhere around 2.5 decades ago, we started treating winter like it was some sort of existential threat. And the central planners increasingly intervened to try to keep it at bay and have it be eternal summer. And uh, what we end up doing is distorting and deforming the system such that you get a lot of unnatural outcomes, like asset price bubbles and things like that. You let debt levels get taken onto levels they never should have been taken onto. And when you do eventually get a recession, because you can't keep reality at bay forever, it tends to be a lot more painful and a lot more destructive than it otherwise would have been, because you've done everything you can to try to hold it off for so long. So I agree with you that a recession is not to be feared here, although if we do have one, it probably is going to be pretty painful because we've deformed the system so much up until now.
Yeah, and not to say we shouldn't fear it. When you're deeply indebted, you're not financially resilient, and the whole world is deeply indebted and non-resilient right now. So anything that happens, even like a normal recession, can be dangerous just because there's so much bad debt out there waiting to blow up. And that explains the reason that governments and central banks are so ready to bail out everybody in sight, because they're terrified about what would happen if they don't. You look back at Lehman Brothers, which people blame for the Great Recession in 2008, 2009. And that was one brokerage house that the government let go bust rather than bailing it out. And that spooked everybody else. They were all wondering who was next and acting accordingly. And the economy basically almost died back then. It was a very close call. The government had to step in with trillions of dollars of bailouts. And so that's kind of where we are. Anything that used to be a mini crisis that was unpleasant, but that you got through it, now is an existential threat. So this time around won't be any different. Well, this time around, two things are going to happen. One is that in a recession, government spending normally goes way up, which means deficits will expand from their, we're running crisis level deficits right now in the US, $2 trillion a year. They'll go to 4 trillion in the next recession. So that will turbocharge the debt cycle and the interest cost cycle. And the second thing is that the world's central banks will jettison the whole higher for longer thing immediately as soon as a recession and an equities bear market starts to happen. And they'll go back to cutting interest rates aggressively and buying up assets via QE programs and things like that. And maybe even take us back to negative interest rates again, just because they'll be so spooked by the prospect of a recession being something much more serious. So again, that's familiar too, because we just went through it in the previous decade. But it doesn't mean it's a good thing. And it doesn't mean it in itself, these bailouts and a new round of QE and stuff like that, it doesn't mean they're not dangerous in and of themselves. So basically, the process that you described before was one of the creation of moral hazard more than anything else, where there's a lot of big players out there that think they can do anything they want to, take any risk they want to take, and pocket the fees because they know governments are going to bail them out. And they're probably right. So the question becomes, what is the effect of the next round of bailouts? And is it possible to create another $10 trillion of currency and dump it in the market, leading to another $50 trillion of debt being taken on around the world? It's not clear that's even possible, and I think that's why this decade is basically the end of the experiment, because we're reaching the point where the numbers are just so big, and the amount of debt that's going to be sloshing around out there is just so unwieldy and so dangerous that the system more than likely breaks. And that's when we get the currency reset, which you and I have been talking about for seems like a decade or so now, right? As an imminent possibility, and now turned out not to be imminent, but it is definitely inevitable. And I suspect it comes pretty soon, given the parabolic rise in interest costs around the world.
Okay, so thank you, because you answered the question I was going to ask next, which is after this recession, or once this recession hits, do you see the same playbook of aggressive central bank intervention to try to rescue things? Sounds like the answer to that is yep. And presumably in the near term, they will succeed to a certain extent. But you think that as we look over the span of the decade coming ahead, it's going to get harder and harder for that playbook to continue to keep things going. And, by the end of the decade-ish is where we really get into the time frame where the system really begins to crack under the weight of the debt, and the casualty of all that, the main casualty of all that will likely be the currency. And these, again, are all things that you have written about for well over a decade, including in your book, The Money Bubble, which I mentioned there in the intro. So let me, I want to get up to the question of, like, what do you think are really going to be the triggers that break the system here, and why you feel this is so inevitable? But let's get there through what I think the main pathway function is, which is the debt, right? Now, you sent over a couple slides. I just want to pull them up here because I think they're good ones. One is the increase in interest payments, and this one here, John, the chart here says personal interest payments. So is this on consumer debt? Is that what we're looking at here?
Yeah, this is a good recession indicator here. This is the amount of debt or amount of interest that people are having to pay now, not governments, but mortgage holders and people with car loans and people with credit cards. It's all of that kind of debt. And look what it's doing. It's going straight up almost. And a big part of that is because cars got more expensive, houses got more expensive. So if you're going to buy one of those things with debt, your monthly payments are much higher than they would have been just a decade ago. Credit card debt is rising. It's over $1 trillion now, and credit card debt is outrageous. It's, one step removed from loan sharking, what the credit card companies do. So you got people paying 20 or 25% interest on some of their debt, and there you have it on that chart, straight up. Now, how long can that continue to go on? In other words, if debt goes from, or total interest expense for individuals goes from 600 billion a year to 1.2 trillion, what happens to consumer spending? Well, would argue that it plunges because consumers have to pay so much on their debts that they cannot take on new debts, or that they can try, but it gets harder and harder, and then they can't make the interest payments when the time comes. So that right there is a chart that predicts an imminent bankruptcy for a big part of society.
Yeah, well, so what's interesting here is if you had asked me back at, I mean, whatever it is, 2021, two, when the spike here started, or right before it started, if you had said, "Hey, Adam, how many people do you know who could absorb a doubling in their debt service costs, right, in their personal lives?" I would have said painfully few. I don't know how many households would have been able to really do that, right? So I think that's still an open question, right? Where clearly that's happened. Now the question is can households sustainably absorb this? Provided that interest rates don't go even higher from here, or has the damage been done and we're just waiting for the time delay before the bodies start floating to the surface here? Now, if we look at things like retail sales, they have really growth in them has completely petered out. I think last month retail sales grew by like 0.1%, and that's not inflation adjusted. So you take inflation into account and they actually shrank on a real basis, right? So we're seeing the consumers having trouble maintaining their current level of spending. We've seen a lot of big brands, right? Walgreens just came out last week with very disappointing forecasts citing weak consumer spending, and their stock got hammered like 20% overnight. We've seen the same thing with brands like Starbucks and Target and a number of others. These are big consumer brands that are saying, yeah, we're seeing people just don't have the money to spend that they used to. And you're talking about a topic that our good friend Charles Hugh Smith has mentioned for decades now, which is debt saturation, right? You get to a point where the consumer takes on the maximal amount of debt that they can afford to. They either can't afford to take on any more debt because then they can't meet their other debt services payments, or the lenders cut them off and say, I don't care how much more debt you want. We're looking at your personal balance sheet and we're not giving you any more, right? So obviously a spike like this is very concerning, and can't continue for much longer for all those reasons that I just mentioned here. Okay, so we've got this happening on the personal side of the balance sheet. Now, if we go to the government side, you can just see how U.S. federal debt's been growing at a truly exponential level here, and now it's just mind-boggling. We've added 11 trillion in federal debt since 2020. Everybody's seen the headlines that we're adding $1 trillion every 100 days now. Let me ask you this, John. I mean, do you expect this growth to moderate in any way, or is this just, as Wolf Richter likes to say, dead out the wazoo from here on out?
Yeah, it can't moderate. That's the killer part of this, because if a government tries to scale back its borrowing, which is to say if it spends less or raises taxes, that slows the economy down. And then you get all the bad debt in the private sector starting to blow up. And then the government has to step back in with bailouts, which raises its borrowing again. So we're past the point where there's anything to be done about this. And we've already responded to a bout of inflation with much higher interest rates. So you combine higher interest rates with the debt explosion on the chart that we're looking at now, and that's where you get the soaring interest costs. The debt is going up, the cost of the debt is going up, and so total interest is through the roof. And how do you fix that? Um, you can't moderate economic growth by moderating government spending, because that blows up the economy. So there's no choice but to keep on going as we're going, or accelerate the process. You know what you're hearing lately, and people might have even said this on your show in the recent past, but there are a lot of analysts out there saying that the only way we get out of this is if we raise the inflation rate above interest rates, so that we inflate away our debt and make it easier to manage. But I'm sorry, that sounds crazy. The reason that wouldn't work is that everybody would see what was happening and they would front run it, right? If it's government policy to have 4% inflation and interest rates are 2 or 3%, then obviously you want to borrow money at 2 or 3%, knowing you get to pay it back at a, a depreciated currency. And that means debt goes parabolic, even more parabolic than it is when you try to inflate it away that way. So you end up with more debt, higher interest expense, and an even bigger problem. So even the solution that a lot of people are pointing to now won't even come close to working. It'll actually make things much worse. So there's no way out of this. And you know, Japan is actually the poster child for where the rest of us are heading. And what's happening with Japan is that in the 1990s, they had their big real estate bubble, and instead of letting a lot of that bad debt be worked off through default, they decided to bail everybody out with government deficit spending. So their government debt has been going up ever since, to the point where, on a per capita basis, Japan is the most indebted government in human history. And they got away with it for a really long time because they had negative interest rates. So they actually made money by borrowing for quite a while there. But then inflation erupted in 2022. Japan had to start letting their interest rates rise a bit. And at the same time, the yen is plunging. The exchange rate of their currency is falling while their interest rates go up. So you see the yen dollar exchange rate there just consistently falling for the last few years. And meanwhile, their interest rates are starting to rise at the same time. So you've got two problems, which actually I think we have a chart for the 10-year treasury yield in Japan too, Adam. If you could pop that up, that would show the contrast of the yen versus interest rates in Japan. And so basically, they have two problems now. Right now, interest rates are going up, which is spiking their government's interest costs. And if you have debt at 260% of GDP, and your interest cost goes up by just 1%, that's an extra 2.6% of GDP that you're paying out in interest. That's completely unmanageable. So they can't let interest rates continue to rise or they go bankrupt. But normally when your currency is falling, you raise interest rates in order to protect your currency and keep it from just falling off a table, and the decline being unmanageable and disorderly. But if you can't raise interest rates this time to protect the yen, then what do you do? And the answer is there's nothing you can do. You're in a box that you can't get out of. And basically your financial system is going to spin out of control. And that's where Japan is. But because they started a little sooner, the rest of the world's not there yet, but we're heading in that direction. The US is heading to exactly where Japan is now, to a place where we start to have inflation, which is to say the dollar starts to fall and the value of the dollar starts to fall. At the same time, interest costs are soaring, and there's basically nothing we can do about any of it. So at that point, that's when you get into people talking about currency resets. And we're not there yet, but Japan shows that we're not far from it. So keep an eye on Japan, because a lot of what happens there is going to be replicated in the US in 2 years or 5 years or whatever. We can't know the time frame, but we're all in basically the same box, just on a different period in the process of the fiat currency experiment. So I think that watching Japan and seeing that they're in a box that there is no escape from is kind of the proof that we need to expect the US to end up in the same place. So that's our decade. It's going to be terrifying, but also fascinating and potentially incredibly profitable. Here's the good side of all the gloom and doom here, which is that it's an investment thesis. If you see this stuff coming, and you see this gigantic financial crisis out there, even if you can't know the timing, you know that that crisis is going to create lots of opportunities. So the intellectual challenge isn't to figure out whether we're headed for a crisis. We clearly are, but to figure out how you position yourself so that you're at least protected. And in a best case scenario, that you make life-changing money and you're able to protect your family and help your friends out and do all the things that rich people who are also good people tend to do with their lives.
All right, so I've got some other questions that maybe we'll pepper in the discussion as we go on here, but I think you put your finger on the thing that most viewers are most interested to hear about. So let's just roll up our sleeves and dive right in. Okay, so I think this is apocryphal. I'm not sure if it's exactly true or not, but we've all heard the saying that the symbol in Chinese that stands for crisis also stands for opportunity or something like that. And you're basically delivering a similar message here, which is, hey, it's not a hopeless future, but it's a future where you can control your own destiny. There will be some opportunities perhaps here, but there's a risk here that a lot of people could get very damaged financially by what you see ahead. But for those that are aware of it, positioned prudently in advance, there may be some opportunity here to come out of this okay, and actually maybe some opportunity to come out of here having vastly improved your situation, at least on a relative basis, by making savvy investment decisions based upon what's actually unfolding. So I guess, where do you see the opportunity here, John, specifically? Is it on the short side? Is it owning assets that will preserve purchasing power from inflation, hyperinflation, currency destruction? And if so, what asset classes fit those type of requirements?
Well, you mentioned shorting, and that's an aggressive thing to do. As anybody who's done any shorting in the last 5 years has discovered, it's incredibly risky unless you time it right. Remember that little 3x ETF you and I were playing with that was a way of shorting the NASDAQ?
Yep.
I can't remember how far away that or long ago that was, but it seems like it was several years ago. And that was a terrible thing to be playing with
Yeah,
back
and to be
then.
clear, it actually wasn't shorting the NASDAQ, it was shorting the FANG stocks, the FANG stock complex
That's
back then.
right. That's
Yeah,
right.
and maybe while you're talking, I'll see if I can pull it up and we can show people how bad of an investment that was.
Oh my God. It's probably zero almost from where we were looking at it before. And that illustrates how seductive shorting is and how dangerous it is at the same time. Because unless you time it right, you can lose a lot of money when you short something. Because a stock has no theoretical upside limit, right? So if you buy something, it can only go down 100%. But if you short it, it can go up 1,000%, and you might be on the hook for it all the way up. So it's dangerous, but there will come a time when somebody times it right. And the reason why, especially US equities, are so interesting now from a short standpoint, I think can be summarized by a saying that Bill Fleckenstein, who I think you've interviewed him before, right?
I have interviewed Bill,
Yeah,
yes, many
that
times.
he was a big short seller all the way back in the 1990s during the dot-com bubble. And he used to say, the global economy depends on the US economy, and the US economy depends on the US stock market. And the US stock market depends on 10 stocks, only 4 of which are profitable, as a way of illustrating the fragility of the global economy. It's basically true now about the small number of stocks that the US financial system depends on, although they're profitable this time, but they're wildly overvalued given any historical measure of stock valuation relative to profitability. So we're probably going to have something at some point like the dot-com bubble bursting and the crash of 2000. In the not too distant future. And a handful of people, maybe more than a handful of people, are going to time that right by shorting aggressively into it. And they're going to make life-changing money. Some of them are going to become household names in the financial world, at least. And it would be really fun to be one of them. It's just the timing is just so scary. But to know what we know about how overvalued the US stock market is and to completely miss the coming bursting of the bubble and the bear market that follows, that would be too much to bear. So I feel compelled to be short, but not big short, just short enough to be able to watch it work out on at least a small scale. But it's really hard to resist the temptation to go big when we're watching what's happening with, for instance, NVIDIA, where it has had, an epic run for equities. That might be the biggest increase in market cap for any stock in 2 years that has ever happened. And meanwhile, it's getting a lot of competition. And, as Fred Hickey, who you had on your show a while ago, said very compellingly, that the AI bubble is not working out the way everybody expected. There are a huge number of people out there building AIs, but very few people have figured out a way to make a profit from all the hundreds of thousands of dollars or tens of millions of dollars that they're putting into their AI.
Hundreds
So
of
what,
billions in
yeah,
collectively, but yeah.
yeah, collectively. But it depends on how much each individual person is spending, but they're all spending serious money um, for their own situation. And unless they figure out a way to make money in the very short run right now, then the demand for AI chips is going to have to moderate. And NVIDIA is not priced for moderation, and neither are a lot of their competitors. So it's possible that, when the dot-com bubble burst in 2000, a lot of the companies that went way down were still great companies. I mean, Amazon, Cisco Systems, lots of other companies like that. They went on to do big things, but they just lost 90% of their value when the bubble burst. And it's completely envisionable that a lot of companies that are the highest flyers right now have the same kind of stock market fate. But as companies, most of them will still be fine 10 years from now. They'll be making a lot of money. They will have changed the world, but their stocks could have a very sharp decline from here as the hype cycle plays out. And we find out that, these guys aren't going to make trillions of dollars a year each going forward. It's going to be something much less than that. And it's going to be erratic. So their stocks shouldn't be priced for perfection. And okay, somebody's going to make a lot of money with a short bet on that thesis. But the question is, when are they going to do it? And how much will these stocks go up before they go down? Okay, so that's the investment thesis and the scary part of the investment thesis for shorting. In the realm of relatively safe things, there are commodities. We're trying to electrify the world right now, and the plans that a lot of people have. And by the way, electrifying the world includes coming up with the electricity necessary to run all the server farms that are running the AIs that we're building. So that's a brand new element in the demand story for power out there, but it might end up being the biggest single part of that story. So we need a lot more electricity. And people could just kind of take it for granted that we're going to be able to find that much more electricity out there. But there's a chart or an image that I have somewhere on my Substack feed showing two cubes. One is a cube that representing all the copper that has been mined in human history up till today. And then a cube showing how much new copper we're going to need to electrify the world by 2050. And the second cube is much bigger than the first cube. So we need more copper than we have found in all of human history up until now in order to make good on the plans that are now in place. So what does that mean? That means much higher copper prices, right? To incent a lot of new mines out there. And same thing with silver. Gold is a separate story that is phenomenal because of the currency crisis that's coming. and pretty much name your commodity other than those three. And there's a great story to be told about each one. So the commodity sector looks like it's going to have a lot of big winners going forward. But there's an issue there too, because mining is a very tough business. So you can't just go out and buy a random selection of copper mines and silver mines and gold mines and expect to profit dollar for dollar with the increase in a lot of these commodities. Because normally mines do better in bull markets than the underlying commodities, but it's not at all clear that that's going to be the case this time around. Because, for instance, just to take a couple of examples, the Cobre Panama mine, which is one of the world's biggest copper mines, was just summarily shut down by the Panamanian government because of environmental protests. And that just took a big chunk of future copper production out of the equation. And then there's the Victoria Gold leach pad that just sprung a leak up in the Yukon. And there's lots of mines being developed up there. But this Victoria Gold problem might delay and or shut down a lot of those new mines that are coming online. So that means a lot less gold and potentially less silver up there. And there's variations of these kinds of problems all over the world, especially geopolitical, because you never know if the country that you build a big mine in is suddenly going to see a revolution, and the new guys coming in are not going to want to work with you on the same terms going forward. So I'm starting to think that maybe the physical ETFs are a much less risky way to play what is probably going to be a commodities bull market going forward, because a physical ETF basically, and there seem to be some ethical questions with the business model, but nobody's talking about banning them or anything, so okay. But what a physical ETF does is it goes out, raises some money, goes out and buys a lot of a given commodity, then stores it. It takes it off the market. So two things happen at that point. One, by buying the physical ETF, you profit from having some of this commodity that has a good story. The other thing that happens is that by taking that commodity off the market, the ETF, other things being equal, raises the price by restricting the supply of that commodity. So it's kind of a perpetual motion machine. The more money it raises to buy commodities and takes them off the market, other things being equal, the higher the price of the commodity goes, which makes it easier to raise more money and so on. And it's kind of happening with the Sprott uranium physical ETF, where they've taken a lot of uranium off the market as uranium has gone up, and they've played a role in tightening supplies out there, and they've benefited from it. So I think it's possible to put together a portfolio of physical ETFs in the commodity space that are relatively low risk. I mean, you don't have any kind of mining risk. Nobody's going to shut down a mine and screw you up if you're a physical ETF. It actually helps you because it restricts supply if somebody's shutting down a mine out there, which makes the value of what you've got in your vault even higher. So, there's physical ETFs for silver, for gold, for uranium. They've all done very well lately. And now Sprott is bringing out a copper physical ETF, which as soon as it's available in the US, I will definitely buy some of. So that's a very compelling small portfolio that you can put together and basically takes care of the commodities bet for you. So I think it's a very interesting thing for people who want to minimize risk, who don't want to go to the trouble of analyzing individual miners, which is a very tough thing to do, but who still want to profit from commodities going forward.
Super interesting. So let me ask this, John. So I've known you for a long time. You have been an active investor in the precious metals mining companies for a long time. I know you've been pretty active in them over the past year or so as well. But you did raise, some of the issues there, and they have, disappointed to a certain extent. I mean, they've largely done okay over the past 6 months, but have underperformed the metals, which is not their job. Their job really is supposed to be a leverage play on the price. So now you're saying, hey, there's actually some reasons to maybe start preferring the commodity ETFs over the miners. Are you actually planning on shifting the composition of your personal portfolio with this thesis?
Well, I'm shifting in that direction without leaving the mining space altogether. The most successful mines are going to be huge winners. There are some big ones that'll probably be five baggers going forward, and some small ones that might be 10 or 20 or 50 baggers. Okay, so those things they exist out there, but I'm less, and for instance, Rick Rule or somebody like that is capable of separating the wheat from the chaff because he's been an analyst in that space for 30 or 40 years. But I'm less and less confident of my own ability based on what's been happening lately of being certain about a given mine, being able to get from here to there to 3 years later when it's bought out for 5 times its current price, say, without a lot of growing pains and without a lot of geopolitical intrusions and things like that, just because so much stuff is happening just out of the blue. I mean, that Panama thing, geez, and the Yukon thing, neither one of those were on anybody's radar a day before it happened. So I'm less confident that I can put together a mining portfolio that is relatively low risk and high potential reward. So, I'm shifting a little bit of money over to the physical ETFs, relatively speaking,
Oh,
away from one sector and into the other sector. But I don't think you should go completely there. I'm just saying it's in this world with what's going on right now, that's a relatively safe way to play commodities, in a world where commodity mining is less safe than it used to be.
got it, got it. And a couple things. One, you mentioned the physical ETFs. There are ETFs out there that basically buy futures contracts. And there you do still have counterparty risk, right? Where the ETF doesn't actually own the physical metal. It owns a paper contract, largely one that'll probably roll over when it expires. But it means that, hey, if things got really tight supply-wise, the ETF might actually not be able to secure or procure enough of the physical underlying metal to map to the paper capital that is flowed in the ETF. So you want to be looking for ETFs that actually do store and house the underlying physical metal and I know like the Sprott funds that you mentioned, they're in most cases it's a one-to-one backing, I believe.
Yeah, nothing that involves futures contracts is low risk. Certainly not risk-free, but it's got that counterparty risk you mentioned. And in a financial crisis, counterparties are just going to be dying all over the place. So to pull up a historical example, in 2008, the banking system was in a crisis, and it turned out that AIG, a big insurance company that was a counterparty on all kinds of derivatives out there, that their derivatives book was blowing up on them. And as a counterparty, they were no longer going to be able to function. They were just going to cease to exist because they had so many derivatives losses that they were completely unmanageable. That would have, if they'd been allowed to die, bankrupted JP Morgan Chase, Goldman Sachs, Citigroup, you name it. Every big bank would have ceased to exist. And that's the kind of thing you don't want to be exposed to. Futures contracts are going to go the same way potentially in the next big financial crisis. So you really don't want to be involved with them because, see, that's a risk that's separate from the risk in the commodity that you're betting on. Because I'm saying there's going to be a great decade for commodities and everything. That's not 100% guaranteed. That's likely based on some big trends out there, but it's not guaranteed, and it's not guaranteed for each and every commodity out there. So you're taking a risk by buying a portfolio of physical commodities funds. But if you layer completely unrelated counterparty risk on top of that, then how are you going to sleep at night? If you know what your risks are, because at any given morning you can wake up and find out that the entity that was the main counterparty on a big chunk of your financial risk just ceased to exist. And now you're depending on the government to bail you out. And they might not be able to do it because the currency is crashing. You don't want to be in that position. You want to be as close to physical ownership at hand as you possibly can be with a lot of commodities. Not everything. You can still buy, equities in the mining space, but the bedrock part of your finances should be stuff that you have the ability to access and that doesn't depend on counterparties making good on a promise.
Okay. So one of the other things you mentioned about these commodity ETFs that I just want to note is you talked about the projected demand for a lot of these commodities. And Rick Rule comes on and talks about this all the time for I mean, almost any commodity we can think of. But when you think of ones that are tied to the the electrification of our transport grid and building the new green energy systems of tomorrow, it's a gargantuan amount of new material that's needed. You talked about the cube of basically showing that we're going to need, some multiple of all the copper that's been mined in history over the next decade or so. So we got to go out there and find that stuff. And just one thing to be aware of is humans being efficient or lazy, however you want to categorize us. When it comes to mining, over the past millennia, really, we have gone after the easy to get stuff first, right? The richest ore veins. While you were talking, I was trying to find on Google. I didn't succeed, but I've seen photos back in the 1800s of these guys up in the Klondike, I think, leaning against like a Volkswagen-sized boulder in a riverbed. And that was a massive copper nugget just sitting right there on the ground for the taking, right? Those are long gone. And if you follow the mining spaces, I know you do, John, you know that the ore veins that we're going after today are much more dilute than the ones that we went after 50 years ago, which are much more dilute than the ones that folks in the older days went after with their pickaxes. So we have to do an awful lot more work to get what's out there out of the ground and concentrate it, smelt it, concentrate it, refine it. My point there being, though, is just that all takes work, and work comes at a cost. And therefore, if we are indeed going to go after that multiple of all the copper, for example, in the world that we've mined up to now going forward, the underlying cost of the commodity is just going to have to go up based upon the fact that we're going after harder and harder to get deposits. And then you add into that demand factors as well, and it's just, there's a lot of tailwinds, I guess, at the back of the fundamental commodity prices for this reason. You add to that your point about how these physical ETFs are basically taking supply off of the market and therefore increasing scarcity, which of course, even if demand stays the same, but scarcity goes up, price needs to go up. And of course, if demand goes up too at the same time, it's a multiplier. So there do seem to be, a lot of compelling reasons to just play it safe and go after the beta of the commodity itself and not have to worry so much about the alpha risk, going after the miners.
Yeah, there's a lot to be said for minimizing risk, and the mining industry has just seen its risks rise dramatically. Another way to do that, although this doesn't completely eliminate the risk, but it diversifies part of it away, and that is the royalty and streaming companies in the mining sector. What they do is they're basically finance companies who go out and they'll find a junior miner who's trying to bring a mine online, and they'll say, okay, we'll give you $50 million to get that mine up and running, and then you give us 2% of the mine's output for some period of time, or forever maybe, or something like that. And so the big royalty companies end up with dozens or hundreds of deals like that. And they're at fixed price or fixed percentage price relative to the underlying commodity. So they've got very wide margins and they're diversified so that no one streaming or royalty deal can bankrupt them. Um, and yet they still participate in the rising price of the commodity. So
Right.
that's another way to do it.
And sorry to interrupt, but in a royalty or a streamer where it's a contract, right? So the terms are set at time zero. So every increase in the price of the underlying metal, 100% of that goes to their bottom line because they don't have operating costs or anything like that, correct?
Yeah, they've got really tiny staffs. On a revenue per capita of staff basis, they're among the most efficient companies in the world because they're basically finance guys going out and doing deals. And then once the deal is done, there's very little for the royalty company to do. The miner is just supposed to start sending them
Right.
either.
You just answer, you open the mail
Yeah,
and cash the
yeah,
checks, right?
yeah, basically, yeah. But they're not risk-free because, for instance, the biggest one of these companies, Franco-Nevada, had a big bet on that Cobre Panama mine. And they, so far looks like they've lost that entire bet. It looks like $1 billion just evaporated for them. So one of the lessons for that from that is that even the royalty streaming companies have to be careful about how much capital they commit to any one project, and they need to be really diversified to live up to the hype. But the ones that are, and I think Franco-Nevada kind of took one for the team here. It showed all the rest of the royalty streaming companies how diversified you really need to be. So I think the industry got smarter because of that. And I think the best, highest quality royalty streaming companies are going to do as well as most of the gold and silver and copper miners in a bull market with much less risk in the aggregate. So that's another way to do it. So, it is possible to play the commodities market going forward while minimizing your risk. Can't eliminate it, but you can minimize it.
All right. Well, you've given folks something to go look into, and folks, I did an interview with uh, Jonathan Wellham, who is uh, the head partner at Rocklink Investment Partners, which is the financial advisor endorsed by Thoughtful Money for Canada. His firm invests in the royalty companies and the streamers, and he goes really deeply in explaining the business models of both those different types of companies, names a couple of the ones that his firm follows closely. So if you want to learn more specifically about that particular segment of the mining industry, go check out that video. All right, John, look, it's always just so fun to just be able to sit and look at the future through your eyes. Thanks for being so practical today, both in terms of outlining the specifics of what you see coming, but ways in which people may be able to play this and do quite well. And even if they just confine themselves to sort of the beta, as we're talking about here, which means sort of the general industry return versus trying to get outperformance that a specific particular company might give us. I'm presuming you think that's a pretty sound strategy, because the type of future that I think you see coming, and I'm not necessarily talking about the short term downturn in the markets that you think is going to happen, although it should work there too. But this is more in the long run. Seems like your long run strategy is, you know, those who will do best are those who lose the least, right? Like if you just sort of, place your money intelligently so that you're not as nearly as damaged by many of the other asset classes that I think you think are more exposed to the factors we talked about earlier. Like that's a strategy where you're going to do really well and maybe don't have to take on excessive risk while pursuing.
Yeah. And I think where you fall on that spectrum um, of um, of risk reward is determined by how much you understand the industry in which you're investing. If you're a regular person who heard this but who has no specific mining expertise and would like to get into commodities, then you want to do the physical gold and silver stored at home and physical ETF kind of strategy where you stick with mostly the physical stuff, and you make as much money as the commodities go up, which will still be pretty good, and your risk will be minimized. If you've got a lot of experience in mining, or you've got some insider information or something like that, you can go much further out on the risk spectrum and hope to make some big multiples of what the underlying commodities do. But unless you have expertise, you really can't separate the wheat from the chaff in markets like that. So you want to be extra careful. And so it's kind of a look in the mirror proposition, figure out how much you know, and then base your investment strategy on your level of expertise or lack thereof.
Great, important point. You're kind of making my point for me. On these videos, I talked about how the vast majority of viewers should be working with a professional financial advisor who is well experienced in the strategies that the guests here talk about. And two things. One, your point about shorting, I just want to completely underscore, which is it is very difficult under the best conditions to make money on the short side because the timing part is so important. So, none of what John's talked about obviously is personal financial advice. And if you think you might want to entertain doing something on the short side, unless you have a lot of experience doing it and doing it well, highly recommend you seek the counsel of a good professional financial advisor on developing a strategy for you for how to do that. Similarly, on the commodity side of things, if you want to get into that space and you're not already well experienced, then talk to a professional financial advisor who has a lot of experience investing in that space. And lo and behold, the advisors that are recommended by Thoughtful Money actually do. So they'd be good guys to start with. All right, John, look, for folks that have really enjoyed this conversation, would like to follow you and your work between today and the next time you come on this channel, where should they go?
I'm at rubino.substack.com, and that's a newsletter that focuses on actionable advice for what's coming. In other words, we know there's going to be a big crisis of some sort. What do we do about it? And so far, so good. It's a year and a half old, and it's attracted a nice community of people. It's really interesting to be connected to them.
Well, you do a great job there. So, John, when I edit this, I'll put up the URL to the Substack so folks know exactly where to go. Folks, there'll be a link to it as well in the description below this video, so you can get there with one click if you want to. I just want to remind our viewers, too, that of our Macro Pass program, which is if you are a premium member of Thoughtful Money Substack, every week there's a new report from one of the experts that I interview on this channel. One of their premium reports that they send out privately to their premium subscribers. Every week, one of them shares one of them with me, which I then share with our premium Substack subscribers. John is a member of that program, but I highly recommend that you don't wait for whenever John's rotation is going to come up, and instead just go subscribe directly to his Substack there. All right, John, last question for you. So, like I said, I've known you for 15 plus years now. You've been a highly successful analyst, author, and investor. What's one important lesson that you've learned along the way that you think is worth sharing with this audience?
Well, by far the biggest lesson is that you should not let one winning streak convince you that you can't lose. Because I think that's one of the big lessons that everybody has to learn. And the way you learn it normally is that you make some money. You place some good bets. They pay off. You have more money than you ever expected to have, and then you think, well, why don't I quadruple that from here? Because I'm always right. And you roll the dice and you lose. You give back a bunch of that money, or all that money, or more than the original amount of money, and then you lose that you can be wrong even when you've been right lately. And that is the most crucial thing that an investor, and certainly a speculator, has to know. And so hopefully you hearing me say this will prevent some people from having to actually live that experience, and maybe learning it just by hearing it. That's unusual for humanity, but if a few people learn that by hearing it from me, then I'll feel like I was successful.
I could not agree more. I've seen it many, many times over the years with investors. But I've also seen it many, many times. I live out in San Francisco Bay Area. I worked in Silicon Valley before I switched to doing this. And I've seen so many entrepreneurs who had an initial success, right, where they sell a company for gobs of money, and they spend the rest of their lives trying to recreate that success, oftentimes to little avail. And in most cases, it's because they didn't understand the reasons why they were successful, whether they were the entrepreneur or whether they were the investor. Because you can, if you have one good idea, it doesn't necessarily mean you're going to have a lot of other ideas that are going to equate to how good that first one was. But there's sometimes it's just a lot of luck involved, luck of the draw. Maybe you were just in the hot industry right as it got hot. Maybe there was a buyer that just had a corporate need, and your company just happened to be the magic fit for it at the time, whatever. And a lot of times that serendipity can be interpreted by the person as, well, I'm a genius, and therefore I can do this all the time. And my brain is a perpetual money-making machine. And they develop a hubris that isn't grounded in reality. And then you basically just see them take that large pile that they had and just lose it over a long succession of losing bets. And John, you and I have seen a lot of people do this in the investing space. So I highly recommend that people take your comment to heart there.
Yeah, good, Adam. To add one thing to it, it's much harder to be rich, or it's much harder to just be poor forever than it is to be rich and then be poor again. So that's the thing you want to avoid with your money. Do not get round tripped with your entire net worth.
All right, my friend. Well, look, thanks so much again for coming on. It's always such a pleasure, John. Look forward to having you back on the program whenever you want to come back on.
Thanks, Adam.
All right. Well, now's the time in the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. We'll react quickly to what John Rubino just told us, but also talk about what the markets are up to right now. I'm joined as usual by John Lodra and Mike Preston. Guys, great to see you. Mike, why don't we start with you? Any particular takeaway from the discussion with John you'd like to talk about?
Yeah, John talked about the miners in particular, and of course, I kind of keyed on that part of his conversation because something we are keenly interested in too. Something we've been watching for a long time. He cautioned viewers about the negative surprises that have been coming out of the mining group in the last year or so. He mentioned Franco-Nevada. Franco-Nevada had a surprise. They had a mine shut down in Panama. It's a pretty diversified company, and they have rebounded. The stock has almost completely rebounded from that sell-off, but it caused a soft stock performance over the last year or so. And you've had other guests on this program, Rick Rule, for instance, who has said, just get exposure to beta in the sector. And we agree, just get exposure to the gold mining sector. You can use an exchange-traded fund, you can use a mutual fund, you can do whatever you want, but we personally don't think that most people are going to benefit greatly by picking individual stocks in that sector. And we have an ETF. We happen to have GDX, which is a broad large cap mining ETF in our portfolio of about 10% for most accounts. So, obviously I found that interesting. We'd like to share some charts today, maybe a little bit later on, about gold and silver and the miners, which have broken out today, or they're in the process of breaking out of their consolidations. And so gold and silver look good, the miners look good. And I'm sure that, there's more to the talk that we will talk about a little bit later, but that's the part that I found most interesting and most relevant to what we're doing right now.
Okay. I want to let folks know too, I did spend a little more time talking with John once we finished recording, and he, obviously everything he said he believes in, but it's not like he has sold all of his miners and pushed it all into the commodity ETFs. It's more something that on a going forward basis, he'll just be investing a higher percentage in the ETFs than he has been to date. All right. A couple of things that John mentioned I wanted to specifically follow up with you guys. One, he talked about that he thinks there will be some great shorting opportunities if he's correct in his expectation here that the market's going to go through a pretty big correction some point in the next couple of quarters. And John's the first one to say this, which is the really tough part is timing, right? And so to be super clear, this was not personal financial advice. He did say many times that shorting's a really good way to lose a lot of your money, and a lot of people who try to do the short route probably will fall victim to that fate. But he said some of the people that put on some good bets and have timing luck behind them, they may make some incredibly big returns here. I know that shorting isn't a big part of your guys' strategy. In fact, I don't think you have any shorts on in your portfolio right now, but obviously let me know if that's not the case. But I think you feel similarly to John that there's an uncomfortably high potential for today's highly rich valuations to correct at some point here. And I've been seeing a lot of headlines over the past week saying that purchasing downside protection right now is really cheap on a relative basis. Is that true, guys? And if so, are you taking advantage of that, John?
Yeah, Adam, it is. We do have very big concerns about valuations. We have had for some time, and technicals in the market this year, more or less, have been very, very strong, and that has prompted us to be more allocated to equities than we otherwise would be just on valuation concerns. However, in recent weeks, the internals, the technicals of the markets have really started to erode quite a bit. We look at a whole battery of things, sentiment and breadth, and generally speaking, those pieces have started to, we've talked quite a bit, and I know you've had many guests on your channel talk quite a bit about the narrowness of this market, how few stocks are carrying the indices to new all-time highs. The S&P today is on track to make a new high. But it's a very few stocks, and it's easy to say, oh, it's just the Mag 7s, it's just a NVIDIA. We're not going to jump on that train, but if you look more broadly under the market, there are fewer stocks participating. Things like percentage of stocks above certain moving averages. We look at various moving average timelines. Things like bullish percents, things like percent of stocks trading above trend lines. These are all more or less turning over or have turned over in a more defensive negative way. And that's something that traditionally is very concerning for a market that starts to look very heavy, certainly under the weight of the valuation. So yeah, we've had ever since the blistering rally from last fall, we have had some out of the money puts in place as a tail risk hedge to take roughly about 15% of our stock market exposure off the table. And I'll just share a chart here just to kind of share exactly what we're doing here and what we have done. Just today, in fact, we took the opportunity to move our puts up on strike price. So Adam, this is a chart of the S&P 500. It's a daily chart. Each one of these candles is a day move. You can see here we're on track to a new all-time high here today. We had a closing high yesterday. We had up until today, we had put options with a strike price of 49.50 right here at this prior low. Today, we moved those puts up to 5,200 on the S&P. That's about a 5.5 or so percent decline from here. So in other words, if you think about this as an insurance policy, there's a deductible of about 5.5% that folks would need to pay in terms of having some downside market action. But beyond that, these puts would kick in and take off the table any further declines for roughly about 15% of our client equity exposure. So and it was cheap to do that. The net cost outlay for rolling those puts up was about $120 or so per $50,000 of equity hedge. So pretty cheap. And the reason it's cheap is because the VIX is very, very low. Here's a chart of the VIX. We're knocking it on, the lows of the year for sure, down around 12. It's not free, costs a little bit of money, but it's a pretty cheap way to hedge, and we have that hedge out through August, and we'll certainly look for opportunities to adjust that as appropriate as time unfolds here.
Okay, and I want to mention for folks that are intrigued by the current economics for protecting their portfolios. Maybe they've got a lot of gains, or they're just worried and they want to buy some insurance against it. If they want to learn the mechanics of how to do that, if they haven't done it themselves before, we just released a primer video on Thoughtful Money a few days ago, of you guys going through how basically your most common strategies for using options to hedge against risk in a portfolio. So you went through covered calls and protected puts and collars. And so if folks want to learn more about the actual practical how-tos of that, they should go watch that video. I'll just recommend too, even if you watch that video, if you haven't done it before, I think it's super important you watch the video so you understand the mechanics of how it all works. But your first couple times buying options, I highly recommend you do it under the guidance of a professional financial advisor, somebody who's done this a lot, so they can look over your shoulder and make sure that you're not making any poor rookie mistakes that might cost you down the road. All right, guys. One other thing I wanted to talk about is we've been seeing increasing signs of weakening in the jobs market, and actually some new data just came out today. We talk a lot about how important the employment market is, because that has largely served as a bulwark between the economy and recession. It was certainly the domino in 2023 when everybody thought we were entering a recession. That was the one domino that just failed to fall. It just wouldn't tip over, and I think that was a really important bulwark for the economy. I've had Michael Kantrowitz on the program. He's got the HOPE framework, right? That's just an acronym, HOPE. The E stands for employment. He's basically created that because that is the process by which economies fall into recession. And the last domino that needs to fall is employment. And as I mentioned, it's been sort of stubbornly resilient, which a lot of people have been very thankful for. But it's now seeming to be wiggling here, wobbling, pretty concerningly. Let me just pull up a couple of charts here. So here's a chart of the initial claims and continuing claims. And this data is put out by the Bureau of Labor and Statistics. We've talked a lot about how this data of late has been surprisingly resistant to change. And that's sort of flown in the face of layoff data that we've been seeing, of rising WARN notices as large companies announce to their workforces that they're going to start doing layoffs. There's been a lot of head scratching on the jobs data that's been put out by the BLS over the past year and a half. I don't have to rehash that here for regular listeners, but as much lipstick as many people have thought they've put on, the pig of this official jobs data, we're now beginning to see surges in both these data sets. In many ways, this just might be, you can make the argument that if these are indeed pretty heavily doctored data sets, we're getting to the point where the folks trying to doctor the data can't hide the fact anymore that things are beginning to soften. I want to combine this data with one other chart, and let's see if I can pull it up here, but it's a chart of wage growth, which has been slowing. And in fact, we're now seeing wage growth at the lowest level in 3 years. It's still positive. But as I've been talking about for a while, you'll see the surge in wage growth starting in 2021. That was during what was called the Great Resignation, where people were essentially telling their employers to take this job and shove it. And that's because they were feeling flush from the stimulus during COVID. Companies had laid off a ton of people right as the global economy got shut down, and were desperately scrambling to hire them back. So the worker felt like they had a lot of bargaining power. There were also forbearance programs, moratoria on a lot of costs for consumers. So they were able to be really picky and choosy. Now those days are over. A really important metric of this is the quits ratio, which spiked during the Great Resignation, but it's now normalized and it's back to historic norms. So my point here is that the pendulum, while we had a brief couple years where it had swung to labor's favor, which was a rare because for many decades it had been in the side of the employers, that brief moment is now pretty much over. Pendulum has swung back to the employer's favor, and now the big question is how much further may the pendulum swing towards the employer? Because if we start getting into a situation where layoffs increase from here, jobs become more scarce, that obviously just places the power more and more in the hands of the folks that control those fewer and fewer jobs. One last thing, and then I'll let you guys react here. I just want to remind the viewing audience that one of the reasons why I'm watching the unemployment data so closely is because when we have entered recession, in the past many recessions we've had, the unemployment rate, no surprise, spikes higher. And it's the kind of thing, which you see here in this chart, is unemployment is contained right up until you hit the recession. And then it just spikes higher and faster than folks can imagine. And if you look at the current data set that we're in right now, you'll see that we appear to have bottomed and we're starting the uprise trend. And if this basically follows the pattern of pretty much every other recession you see in this data series here, going back to 1950, we could be sort of standing on the portal of a dramatic rise in unemployment. And if that happens, obviously that power structure between labor and employer falls much further into the employer's standpoint. And then, of course, we have the big questions of, does that mean there's a recession here? And obviously, as people lose their jobs, they start being able to spend less, which shrinks the economy, which therefore causes more employers to lay off more people. So I'll take a beat here, but Mike, maybe coming to you, how are you guys monitoring this data and what are you taking from it?
Well, clearly the labor numbers were soft this morning, and that theoretically this market has loved soft economic data because it's a sign that the Fed is going to ease. The Fed is concerned about inflation, but obviously if the labor market starts to deteriorate, they're gonna cut rates. I mean, the two things that they care about, their dual mandate, so to speak, is stable inflation, i.e. 2%, and stable job market or consistent employment. So if we start to see this continue to get soft, then the Fed is likely to ease. The stock market is likely to like that. The bond market today, the bond yields are dropping today, and gold and silver are doing well, which they tend to do well with the yields dropping. So all of that is potentially in response to this soft employment numbers. However, we try not to use these things as short-term timing indicators. Looking at the chart that you just had out there, it's kind of amazing just how thin that recession was back in 2020. There was this big spike in unemployment and the recession was gone in a blip. We've entered this new era where every problem is solved by more money printing and more stimulus. And I think we're entering an end game here where this market is on thin ice. I think the market is likely to go a little higher. Who knows? Probably that's really just a guess based on the fact that we haven't seen a lot of FOMO or fear of missing out. As we speak, the NASDAQ and the S&P are at new all-time highs here, but the broader market has not yet joined the party. Will it join the party? Or is this the last gasp that's going to roll over and crash? This is the big question. This is what we debate. We don't know. We think there's likely to be a broadening. And that the data that you see here is probably early in calling a turn. That's the danger of it all. And that's why we try not to predict exact turns. You have to make a decision about what your exposure is going to be. Our exposure is at around 40% approximately, equities for most accounts. But we have these hedges on for right now for 15% that immediately take 15% off the table, down at 5,200 on this new adjustment that we just made. So all of what I just said means that, yes, there's early signs of deterioration. I've got no doubt that we're in the very late stages here, and that ultimately the market will be a lot lower, potentially 50% or below where we are now, even if we go higher for a couple months. So for most people, I wouldn't be cutting I wouldn't be splitting hairs over this. I would get yourself very, very safe right now. For the professionals that can hedge, you can keep a piece of it in there a little bit longer. But the data is getting worse, and maybe it will get worse in the next few months. But like your charts show, they start to get bad, and then boom, all of a sudden it gets really bad. And trying to predict that exact turn is nearly impossible.
Hey, so let me ask you guys this. So yesterday, Jerome Powell spoke and basically kind of, showed his cards a little bit and said, hey, it's looking like things are disinflating now on the pace that we want to see them on. And so, all of a sudden there was all this talk yesterday of, oh, well, maybe we'll get a rate cut in July, right? And obviously that could be part of what's driving this on. Now, today's weak jobs data probably only supports that, right? So, it adds more potential that the Fed could start easing because the labor market's not as tight as it was, and the Fed was trying to get it to loosen up. So what's so interesting is, all right, so market surge, okay, rate cuts coming, right? And I just want to remind folks again, I'm going to put up a chart here of the federal funds rate with the recessions. The data is super clear. Pretty much all the past recessions here were preceded by substantial increases in the federal funds rate. It plateaued for a while, and then we went into recession, and the Fed is cutting all through the recession. And as the Fed is cutting in these recessions, generally the stock markets are falling, or at least falling for a good part of that. So history doesn't show us that rate cuts usher in, a new era, an immediate new era of financial asset price increases. In fact, they kind of tell us the contrary, but the market just doesn't seem to think that way. John, why do you think the market's so bad at remembering that?
Well, the market is always bad at remembering things because it and the folks within it have a tendency to want to believe the narrative of the moment. And certainly the narrative of the moment is one that has been instilled over the last decade plus, that all the Fed needs to do is open the spigots and things suddenly are solved. And I'm going to share a chart to elaborate what you just talked about. In actuality, when the Fed starts cutting rates, if you look over the long history of time, there are times where rate cuts do lead to stock market gains, but the key distinction there, if you go and parse the history, is where valuations are. And the most recent major rate cutting episodes in response to the tech bubble and the housing bubble were absolutely accompanying with very strong market sell-offs, over 50% declines in both cases, even though the Fed was dropping rates just as fast as they could. Each one of these green dots is a rate cut, each red dot is a rate hike. So the jury's out. When the Fed starts to cut rates, we think it will likely be because they'll have cover in the form of major market or economic weakness that has already started the train running downhill in the form of a market sell-off, and the rate cuts will probably do very little to stem that until the panic is basically washed out of the market. That's what happened the last two major bubble tops that we saw in the tech and the housing bubble. Interesting. I think the Fed is going to be reluctant. I did see Powell's comments yesterday. Of course, the headlines latched onto the kind of the positive parts. There were parts where he talked about, we still need to see many months worth of data to make a case for cutting rates. I will look to the Eurozone as a cautionary tale. Last month, the ECB cut rates for the first time, while simultaneously saying their inflation projections were going to be increased. And sure enough, we saw inflation numbers come out this month in the Eurozone that show a turning back up. So I think the Fed has been very clear that they're not going to rush too quickly to come to the aid of the markets, or try to with rate cuts, until they're very confident that the inflation entrenchment is behind us. I want to share one more chart just to kind of, I think this paints a picture here. This is a survey that was done by TransUnion, and it talks about the biggest worries that consumers have. And, not surprisingly, inflation is a big one. Interest rates is a big one. Housing prices is a big one. interestingly, the jobs market, that people's comfort level with their jobs has started to become a worry. And, I've had conversations with clients that they haven't gotten laid off yet, but they're increasingly concerned about their jobs. So just because we haven't seen it flow through the actual jobs number yet, doesn't mean it's not there. In fact, many folks get worried for good reason. They see messaging from the company that, we're starting to worry about costs, things like that. So that's oftentimes, things like this can be a leading indicator to actual job weakness. The other thing I'll point out is there's I would say these low amounts of worry about the possibility of recession in stock market. I would say those are pretty good contrarian indicators when people are really rosy about the stock market, and especially when it's at all-time highs. That's oftentimes a very contrarian indicator.
Right. Those are the typical walls of worry that a bull market likes to climb. They look much more like the slope of hope that the bear market likes to destroy. On the jobs part, I watch the jobs data so closely, as anybody that watches these videos knows. But I've been doing so for a good long while, and I will say, like, it's anecdotal, but for the past year, but certainly in recent months, I've heard tons and tons of stories, both from people I know and reading online, of people saying how hard it is to get a job in today's market. Just how hard it is to even just get a callback or an interview with a company. You hear these stories of people that are sending out, hundreds in some cases of resumes to only get one, nibble, or not even one. And I've heard very few. In fact, I can't remember in recent history where I've heard one of somebody saying, "Oh, yeah, no, it was really easy for me to find a job when I was looking for one." Even though we've been hearing every time an official, Fed or government official speaks, they keep talking about what a strong labor market is, and how they still want to see some normalizing of the labor market. And all the data looks great, right?
Yeah.
It's still very low relative unemployment, whatnot. But it really does not seem to map or match the reported experience from real people.
Right. Yeah, Adam, and it is across the age spectrum. I have young sons in their 20s. The youngest is a year out of college. Many of his peers recently graduated with very, on paper, high demand degrees. They're having a heck of a time finding jobs. So it's not just older folks that are high cost to the companies they work for. It's young people fresh out of college are having markets are pretty tough right now. And it may be regional. My data points are in the Northeast, but I think it's bigger than that.
I think so too. Like I said, and look, there's got to be some data out there that's letting these reports show, all the job openings and all the new hires and whatnot. But man, it's just preciously scarce to try to find a real person with real world recent experience to say, oh no, things are quite good out there. So I just mentioned that to say, look, we've talked a lot in the past about some of the skepticism of these jobs numbers, but given the importance of employment as a bulwark, given the now weakening we're seeing even in the officially reported numbers, if that domino falls, I think that then opens the door to a lot of the things that the skeptics have been fearing. So anyways, who knows what's going to happen? We'll keep tracking it on a weekly basis going forward. All right, well, look, we're gonna have to start wrapping it up here. Mike, I'll let you have a quick last word on the precious metals if you want, because I know right before we jumped on here, you were taking note that gold was up pretty big today, probably in response to the expectation of future rate cuts. But anything else you want to say about its direction?
Yeah, Adam, thank you. Yeah, let's close with taking a quick review of the gold and silver markets and the miners. I'm going to share a chart. I'm going to start with a monthly chart of gold here. Should be coming right up. All right, so assuming you can see it now, here's a monthly chart of gold. And we've talked a lot about this really long consolidation, really one of the best charts I've seen in my career over such a long period of time. This is the 20-year chart of gold. we had this saucer or cup and handle formation. We finally broke out of that about 5 weeks ago. We broke definitively above 2,000 on gold. We're presently around 2330 or so, 2350. But for the last 4 months, look at this triangle consolidation. As we zoom in, it gets a little bit clearer on a weekly chart. Here's your triangle bullish formation. Now, this is what we talked about last week. Watch for a break higher or lower, hopefully higher. I remember saying. Today, we've got a nice move of about $25 or so up in gold. Take a look at a daily chart, and you can see that at least for now, this is early indication that we're starting to break up. It's really early still, and love to see this develop more. If we take a look at silver, it looks similar. Gold has this, probably the clearest on the weekly chart, this bullish triangle consolidation. Silver has more of a bullish flag consolidation. Take a look at silver here. I'll just type that in. Silver looks like this after moving pretty sharply up, and silver hit a 3250 swing high on spot. Had a pretty big 15% consolidation over the last 6 weeks. This consolidation was also seen in gold and in copper. Copper itself had about a 15% consolidation. What we'd be looking for on silver is a break out of this downtrend. On the weekly chart, it really hasn't quite done it yet. Go to the daily, and we're starting to see that this is the first attempt to break out. So both gold and silver have had that first attempt to break out of their channels. If we build from here, my view is it should accelerate and test the recent highs. The recent highs, 3250 on silver. I think we're going to 35 if we break out of this, and it could be quickly. And gold should go to 2,500 plus and see a range of 2,500 to 3,000. The last thing I'd say, take a look at gold mining stocks. Take a look at GDX. It has had a similar consolidation. We were looking for it to break the downtrend. It did. It's still early. It's only a day here, right? GDX and GDXJ are both trying to break out. Let's see what the next week or so brings. But these could be explosive moves if they happen because of this compression. You know, particularly this down compression tends to build energy. And if we see this move, it could be a good thing. So anyway, our targets are the same. 2,500 plus on gold, 34 to 35 spot silver in the near term. So early indications are good, and today is a good start.
All right, well, we'll keep watching this. You know, no guarantees what happens from here, but we'll be tracking it week to week for folks. All right, well, look, John and Mike, thanks so much, guys. Folks watching, if you would like to see John Rubino come back on again in the future, and if you enjoyed the conversation with him, let him know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And just a reminder, we are hoping to hit the 100,000 subscriber mark before July 28th. So there's probably, I'm going to guess, at least 40, 50,000 people watching this video. If you're one of the ones that haven't subscribed yet, please do so. It's totally free. It'll help us hit that milestone. Also, for all the reasons that John Rubino mentioned in terms of the, uncertain and I think, somewhat concerned outlook he has about where things are headed in the markets from here, as well as all the reasons for protecting against downside risk that John Lodra and Mike have mentioned here, highly recommend that most people watching this video consult with their professional financial advisor to make sure that there's a good plan in place to navigate what might lie ahead. If you've got a good advisor who's doing that for you and can execute that strategy for you, great, stick with them. But if you don't have one, you'd like a second opinion from one who does take all the things that John Rubino talked about into account, maybe even John and Mike there and their team at New Harbor Financial, then consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. These consultations are totally free. There's no commitment to work with these advisors. It's just a free public service that they offer. John and Mike, thanks for hanging with me for yet another week, and look forward to seeing you guys here next week.
Thank you, Adam. Follow the channel. Let's get Adam to 100K.
Thanks, Adam. We love being here. Thanks for the opportunity, and we'll see you next week.
All right. Thanks so much, guys. Everybody else, thanks so much for watching.